Okay, everyone, we're going to go ahead and get started. Hi, welcome to Financial Fridays with Sanies and Equitable. Today's topic is going to be saving for college. Sanies is excited to offer these sessions in cooperation with our corporate partner, Equitable Advisors. Equitable has a long-standing presence in New York, and a large portion of their New York client base is built upon the work they do within the public education system. Through Equitable, Sanies members can receive competitive insurance rates and a full array of retirement services, including a complimentary financial profile for Sanies members, which we urge you to take advantage of. This is a great benefit for membership. Joining us today from Equitable is Lucas Jankowski. We'll save questions until the end of the presentation, but feel free to add your questions at the chat anytime. Our Q&A time is best used for general questions, but please know that Equitable team is available at any time to answer your personal questions and confidential questions. You'll find contact information for Lucas and other regional Equitable representatives at sanies.org, and I'll turn it over to Lucas.
Thanks, Lachey. I appreciate that. So I will share my screen. So thank you everyone for being here and having me on today. I'm excited to talk about saving for college. Before I hop into it, I just have to put up an important disclosure. So I'll just have everyone read it for like 10 seconds before I dive into things. So just a little bit about what we'll talk about today. So we'll go through student loans and some different student loan options. We will also then talk about education funding and some different options one would have to actually pay for education. And then we'll also talk about after one graduates, different student loan forgiveness programs out there. And then we will finish with a Q&A. One thing I do want to make sure I say is everyone is in a different situation. Everyone's got unique circumstances. So if you have any questions that you feel are specific to, or they're not general questions, feel welcome to reach out to me, anyone at Equitable on our team, and we'll happily answer those questions on a one-off basis. So talking about federal student loans first. So federal student loans are loans offered by the federal government or federal agency. Common ones would be like MOHELA, NELNET, Advantage is a big one as well. The first thing to understand with federal student loans is there are two major types. There are subsidized and unsubsidized loans. Subsidized loans, you have to demonstrate a financial need for a subsidized loan, and the amount of subsidized loan you get is determined by the individual college. Generally speaking, it's also determined by the year in which you are in college. It's a relatively low amount, usually $5,500, $6,500, somewhere in there, but it does depend on the specific school. Subsidized loans do not accrue interest while you are in school. So this is pretty big. I'll talk about a little bit about my student loans. My student loans did accrue interest during college, and that can definitely add up over time, over a 4-year stretch. Then there are unsubsidized loans, and they're effectively just the opposite. So there's no financial need required. There is still a limit by many colleges. The amount you can get in federal unsubsidized loans is dependent from college to college. But in these types of loans, interest does accrue while you are going through school. Now, with any either subsidized or unsubsidized loans, the payments aren't due until after you graduate. So you don't have to pay during school. However, in some circumstances, it can make sense to pay during school. I'll talk about that more in just a second. Federal students' loans do have a fixed interest rates. So the interest rate does not go up and down dependent on the current interest rate environment. And whether the interest rate environment is like now where it's pretty high, or 2020, 2019 when it's pretty low, it doesn't really matter. Almost all federal student loans that are subsidized are going to be very low, and then unsubsidized are going to be like 5.9 to 6.8, somewhere in there. The other major attractiveness outside of the interest rate behind federal student loans relative to private student loans is there's quite a few different repayment plans. There's about 11 different types of repayment options with a federal student loan. So often you can tie it to your monthly income. So when your student graduates, they can have a payment that's affordable to them. And they don't have to effectively be potentially crippled by the student loan payment, financially speaking. Just to kind of circle back, though, to my point before, talking about paying during school. So many want to help their children, whoever it may be, grandchildren, whoever it may be, pay for college. It does take a little bit of planning and something that myself, my team can help with. But in some scenarios, is that it can make sense to pay the interest on unsubsidized loans during school. You do have the option to do that, and it can often be a small, relatively small monthly payment, but to save them in the long run, over 5 figures in value. So talk to your financial professional about that, but there are strategies to help that amount stay down before they actually graduate. Now, to get a federal student loan, you do have to complete the FAFSA form prior to being eligible to getting the loan. So I'll talk a little bit more about the FAFSA loan, but that is an important note. That form has to be completed. Switching over to private student loans. So because federal student loans, whether they're subsidized or unsubsidized, generally speaking, there is a maximum based on the college that you're allowed to borrow. And oftentimes people can pay for the totality of college through federal student loans. But if they can't, they have to go the private route. So it is a way to effectively bridge the gap between the cost of college and what the federal loans do not cover. So there are no federal forms or anything like that to complete. Common federal or private student loan holders would be Citizens, Wells Fargo, Discover. But really, you can even go online and you can shop all the interest rate and student loans out there and see what's available. I don't know that I would do that. I would stick with some of the bigger players in this space. But with private student loans, they are typically going to be a little bit higher interest rate than your federal student loans. So for instance, basically all of my student loans are private and they were accruing interest during college. And my average loan rate was about 10.5%. So that's a lot. That's a lot higher than 5.9 to 6.8. But the benefit of a private student loan is you can potentially refinance it. Now, that is going to vary depending on the interest rate environment. Right now, if you try to refinance a private student loan, you're probably still going to be higher than a federal loan. In 2019, 2020, when interest rates were very low, you could actually get lower interest rates on private student loans than you could public student loans or federal. Now, with private student loans, there's no payment plans. There's just a standard payment. The private student loan holders, they don't really care what your income is. They don't give you a payment based on that. You will effectively have the option to take a 10, 15, or 20-year loan, and you can stretch the payment out, but that's about all you can do in terms of control over the payment. And then something that's very important to note, federal student loans are eligible to be forgiven. Private student loans are not eligible to be forgiven. Talking about Parent Plus loans. Now, I would say this is an area where a lot of confusion comes in. And the first line you see there is extremely important. I would say people come to me every week, every month, and they say, Luke, we took some Parent Plus loans out, but after my son or daughter, whoever it may be, graduates college, we'll give them the loan and it's their responsibility to pay it. And that's not how a Parent Plus loans. It is a loan in the parent's name. It is a loan that they own. So if the student decides, I don't want to pay that, or I can't afford to pay that, it's not their responsibility to. It is the parent's responsibility to pay that student loan. So that is a very common misconception. It can't be transferred to the student. It's the parent's loan. It will always be the parent's loan. To be eligible for a Parent Plus loan, you either have to be the biological or adoptive parent. Every once in a while, there are the one-off situations where someone can be eligible. And Parent Plus loans generally are going to be higher interest rates than typical federal loans. On average, they're going to be about 7.5% to 8%. Whereas I said the federal student loans for the student are generally going to be like 6 to 7%, which I know may not sound like a tremendous amount of difference, but 1 or 2% more on potentially 25, 50, 100,000 or plus of that makes a very large difference over time. So again, kind of going back to the federal student loan points, if you want to help with college for a student, but you're not really sure how to, I would talk through some strategies myself, another financial professional, someone familiar in this space, because there can be much more cost-effective ways to help pay for college that don't involve taking Parent Plus loans out. I'm not saying that these aren't right for anyone by any means. Everyone's in a unique scenario, but often there are other strategies that can be involved. And there is a max amount you can borrow. You can only borrow the amount that tuition cost minus any other financial assistance that's received or financial aid received. So you can't, for instance, if you want to take a little bit extra out so they can have money for groceries or whatever, maybe you cannot do that with a Parent Plus loan. Now, financial aid. So as I spoke previously on the federal student loan form, you do have to complete the FAFSA form if you are looking to get federal loans. And you have to check the college's financial aid applications requirement. So every college has different financial aid application requirements. Now, if you're in New York and you're going to a SUNY school, are SUNY Oswego, SUNY Portland, SUNY Rockport going to be pretty similar? Yes, but they're not all identical. You just want to make sure you do check that specific college's financial aid application requirements. And you have to apply. So typically you're going to want to apply during the senior year, the fall of the senior year, and then you have to apply each year. That's a common mistake is people will apply before their freshman year, but then never apply again. You're definitely going to want to sit down with your student and fill out this form. You do not want to make the mistakes that I would say I made. So I was 17 years old filling this form out myself. And I didn't really realize that there's a formula for how much financial aid you get. And I just to tell a little bit of a story. I was a good worker in high school, started working when I was 14, was really diligent, never spent my money, put it all in a savings account. Was like, great, go to fill out my financial aid form. And didn't realize this great amount I had saved over the 4 years of my high school career significantly impacted how much financial aid I get. So if you're looking to fill this form out, talk to myself, talk to someone at Equitable, talk to a financial professional, because there is a formula of how that aid is calculated, and you don't want to do what I did and not be eligible just because I had a big amount sitting in my savings account that the government said, oh, obviously you'll use that to pay for that for college. But in my mind, I had no intentions or plans to use to pay that for college. So as I said, just make sure you talk to someone about the financial aid form. They could give some tips and tricks to maybe increase the amount of financial aid you may get. Based on certain what the form says, one may be eligible for Pell Grants as well if they're under a specific income amount. And then always be sure to review your financial aid offer. Colleges make mistakes. So each college will send out the financial aid offer. They do make mistakes. Just make sure you look it over. If something doesn't look right, just call the college, and it doesn't hurt to at least ask the question and make sure you can get someone that can explain it properly. So going into some different college savings options. So I do want to make a note. We're going to go through 3 different college savings options. These are not all the college savings options out there. There are literally hundreds. These are 3 that we more commonly see used, but if you have questions on other options, certainly we'd be happy to go through the other options as well and the pros and cons associated with them. The one you see here is a 529 plan. This is definitely what we see as the most common option, and it is a great option. And if you Google search how to save for college, a 529 plan is going to come up 100 times out of 100. It is a good option. It's not necessarily the best option for everyone. Some of the pros is it is tailor-made for college planning. So you actually get a state tax deduction if it's a New York State 529 plan. So if it's a New York State 529 plan, you get a New York State tax deduction. You do not get a federal tax deduction. The money then is invested and grows tax deferred, so you don't pay interest on the gains as it grows in the account. And then when you go to take it out for college, it is tax free. So if you pay tuition, if you pay room and board, if you pay a meal plan, it comes out tax free. If you pay for gas to commute, that does not count as a qualifying expense. Some of the cons behind a 529 plan, it is very much made specifically for college. So if you save up a bunch of money into a 529 plan and no one goes to college, that is a potential penalty because then you got to take the money out, then you pay taxes and pay an additional penalty on there. And unfortunately, if someone was a diligent saver putting money in a 529 plan, the federal government says, thank you, but we are going to penalize you for doing that. It does count against financial aid. In 2020, or recently, when the Secure Act 2.0 came out in 2024 effective, they made some advantageous changes to 529 plans. So the federal government has seen over the last 10 to 20 years that people weren't using 529 plans maybe as much as they should be. So they've updated some provisions to make them a little bit more flexible. I won't go through them today, but again, if you have any questions on them, please just reach out. We're happy to answer any questions on 529 plans. A non-qualified brokerage account to save for education expenses. So a non-qualified brokerage account is simply just an investment account to invest in stocks, bonds, mutual funds, exchange trade funds, whatever somebody wants to outside of retirement or educational designated account. So some of the pros behind this account is you could put money in today and take it out tomorrow. If you put money in today, take it out tomorrow, you don't pay a penalty or it's not taxable because it wasn't used for college or retirement. There is no funding limit to this type of account. Somebody can put as much money into this account as they would like. And you do have the widest range of investments, but some of the cons to this account, it is fully liquid, so you don't get any tax benefits. You don't get a New York State tax deduction for contributing. As the money is invested and grows, you will pay capital gains tax. And there's no financial aid benefit to this type of account. It's treated as any bank account would be. Where somebody would typically use an account like this is they're saying, my child, whoever is very young, I don't know if they're going to go to college, but I do just want to set some money aside to make sure they have some money if they want to go to college, if they want to put a down payment on a house, pay for a car, pay for a wedding, whatever it may be. That's where this type of account comes in, is they just want to have money set aside for somebody for no real designated purpose. So the next option we're going to talk about is permanent life insurance. And this is definitely a more complex option. And I do want to emphasize it is permanent life insurance, so not term life insurance. The reason permanent life insurance can be used in this scenario is permanent life insurance builds a cash value or an investment account tied to it. So it can be used for a multiple goal approach. So often I will have people come to me and say, we need some life insurance, and we also want to make sure we save for our children's college. Great. In that event, we can use a permanent life insurance because it can cover both goals in one aspect. You can get the life insurance coverage, and the cash value can then later on be used to pay for that college. So one of the big benefits here is you do get some tax benefits. You don't get a state tax deduction for contributing, but you can take the money out tax-free and you do get tax-deferred growth. The other big component to permanent life insurance is it doesn't have any impact on financial aid. The federal government does not view it as a vehicle to potentially be used for college tuition, so it doesn't count against your financial aid. Some of the cons are it is best used with young children. This option doesn't really work if your child's a couple years out from college, it's not going to really work too well. Generally, you want usually about a 10-year lead time. It can be a little bit less, but it doesn't work if they're high school age or plus. With this type of option, though, investment gains can be taxable if it is not structured properly. So this is an option I would say definitely consult a financial professional before using this option. The permanent life insurance has to be structured in a certain way to make it most advantageous for you from a cash value growth, as well as preventing the investment gains from becoming taxable. And with this type of option, you are locked into a premium. Now, that premium can change a little bit, but with the non-qualified brokerage account that I had went through, or the 529 plan went through, at the end of the day, you could put $1,000 in when your child's 1 and never touch the money again, and it's going to be there when they're 18, 21, whatever the age may be. With a permanent life insurance policy, you have to pay into the policy a certain amount of time. So if you get into a situation where you can't pay for a couple years or a year, that policy may end up lapsing. So with this option, it is the most complex of the 3 options that I went through, I would say, and it does require the most amount of care to it. So if this is something that you could see as a potential fit for yourself, like I said, just talk with myself, someone else at Equitable, financial professional, to make sure that they're structuring this properly for you. I would also talk with somebody that's familiar with college savings and then also specialize a little bit more in the permanent life insurance space. The last thing I want to talk about today is public service loan forgiveness. Now, I did mention it in the beginning, but I just want to make sure I reiterate. Public service loan forgiveness is only available for federal loans. It is not available for private loans. To qualify, you do have to work for 10 years in a non-for-profit 501c3 or public school. You have to make 120 qualifying payments. A qualifying payment is a payment that's on time and in the right amount. So it's not early and it's not late. And I emphasize early because people come to me and say, look, I'm 3 months ahead on my student loan payments. And isn't that great? And it's like, actually, no, because you're going to give those forgiven and those don't count as extra payments. One important thing to note, the 10 years and the 120 qualifying payments, they don't have to be consecutive. You could work for a non-for-profit for 5 years, go work for a for-profit for 5 years, and then go work for a non-for-profit for another 5 years. You do need to have direct loans. Direct loans are a type of federal loans. Any federal loan taking out after 2007 is a direct loan, but if you have loans prior to that, they may not be direct loans. And you have to qualify for an income-driven repayment plan. Not everyone will qualify for an income-driven repayment plan. It's based on the income to debt ratio, and there are some other factors involved, and we can help do the calculations on that. But generally speaking, if someone makes $100,000 and they have $1,000 of federal student loans, they're not going to be eligible for an income-driven repayment. They're not going to be eligible to get those loans forgiven. You're typically looking for about a 1-to-1 ratio. At least your income is proportionate or equal to the amount of student loan debt you have, or you have more student loan debt than income. And then if you meet all these requirements, so you have federal loans, you work for a non-for-profit as a full-time employee for 10 years, you have 120 qualifying payments, direct loans, and are on an income-driven repayment plan, you can get the balance of your loans forgiven after the 10-year period. The federal government has definitely made this program more flexible in the last couple years here. It used to be kind of like the jaws of life getting your money forgiven. It's been a lot better over the last couple of years. But if you have any questions on this program, you need help, I would talk with a specialist. We have many specialists here at Equitable. I can help many others. Thank you. Any questions?
I'm not seeing any questions right now in the Q&A. Let me see. We'll give it a few minutes. If you have any questions, why don't you type those in the Q&A, or the chat is fine too. And if we don't, please know that the recording of this session will be posted to the Sandy's website and will be, as will the presentation, and you can contact the Equitable team at any time. Oh, we do have one question. What happens if you started a nonprofit but did not enroll to do loan forgiveness until a year later?
So you can go back and get that time accredited towards you. You'd effectively have to complete the necessary forms, which you can walk through, but you have to complete the necessary forms, have them signed off by someone that can verify your employment for that year, basically saying, yep, you did work there for that year. And then you can get those forms, or you can get those years accredited.
Anyone else? Give it one more minute. We have a few minutes time. Judith, I see in your Q&A, it was just a question mark. There was no question typed there. So if you want to retype it. All right. Oh, there it is. Judith asks, how do I know if I have a permanent or terminal life insurance plan on my child?
That would be on either the life insurance statement, or it would be on the what's called the prospectus when you originally signed up for the policy. Generally speaking, depending on the age of your child, you typically cannot take term out on them. Now, if it's like a work policy, you may be able to take term out. But to get a definite answer, it would be on a life insurance statement, which you should get once a year, either electronically or in the mail from the company. So if you have that and you have any questions, you can reach out to myself, a financial professional, and they should be able to tell you based on the statement what type of policy it is.
Well, let me hold on. Let me see. Let me scroll down. Okay. All right. Okay, I think that is all the questions we have for today. So we'll sign off. And again, you can find the recording at sanys.org, and also a list of all the contact information for Equitable advisors who are always available to answer your questions. So thank you, Luke, and we'll see you all next time.
Thank you, everyone. Have a great Friday.
Bye-bye.